Hi, this is Lara at Elliott Wave Stock Market with an extra update for you after the trading session. Wednesday, 16th of March has closed. We've got a slight new high. It changes the bear wave count a little bit. I'm discarding what was the main bear wave count in favour of the alternate. Short term, I'm still expecting this is a bear market rally until proven otherwise. The target remains at 2126. If we see a new high tomorrow above 2032.59, then we're in a fifth wave up toward that target. But I'm expecting a new low below 2019.06. Tells us we're in a short-term sideways consolidation for a fourth wave. When that's done, then the upward short-term trend should resume. But overall, we're still in a bear market, and I'm going to go to the technical analysis section first and look at this monthly chart and explain why. This is a monthly chart going back to, just a little bit back to before 2000, and I'm going back that far so we can look at what happened with the last two big bear markets, the dot-com crash and the global financial crisis. Let's use the simplest of all technical analysis methods, simple trend lines. For this first bear market here, simple trend line along, if we draw it using McGee's approach from this from the start of the bear market to the first swing high, it would sit around about here. So let's not be quite so conservative and draw a bear market trend line from this high to this big major swing high here. So still a reasonably conservative bear market trend line. While price remained below this bear market trend line, we could assume that the bear market remained intact. When it's breached at a monthly chart level, then we can assume it's likely that the bear market is over and the bull market is underway. Let's draw a McGee trend line. I'm using the approach outlined by McGee in that classic technical analysis of stock trends. For a bull market, we can draw a bull market trend line from the first swing low within the bull market to the first major swing low. Now, if I draw it up here, that wouldn't be so conservative. Let's be even more conservative and draw a bull market trend line to this big swing low here. So this contains all of this bull market tested here, overshot here, and breached here on this monthly candlestick. It was in this month that we were told that something else was happening. This bull market had likely ended and a bear market was likely underway. So let's use McGee's approach for this bear market. From the beginning of the bear market to the first swing high within the bear market, this is a very conservative bear market trend line. It was properly breached back here. We had a fairly typical throwback to that line. This price action here in these months told us that the global financial crisis was over, that this upward movement was not just a bear market rally, it was likely the start of a new bull market. If we want to draw a trend line along the bull market using McGee's approach, I expect we would draw it from this swing high here along up in here, and that's what I did a few months ago to tell us when we'd changed from bull to bear. But let's be even more conservative and draw it from the start of this bull market and not along this low here. Let's be more conservative and draw along this major swing low here back in October 2014. This is telling us now that this trend line is clearly breached, and we had a throwback on this monthly candlestick here. When you look at the daily chart, price breached the line and threw back to the line. It's telling us that the market has likely changed from bull to bear. Here's McGee's trend line for this bear market. From the start to the first major swing high within it up here, also touched here, and we'll look at a couple of slight differences there at the daily chart level later on. This is our bear market trend line. We need to see price breach that bear market trend line by a close more than 3% of market value above it before that trend line is telling us we have likely changed from this new downward trend to a bull market. And there's a couple of interesting things about this bull market spanning over 6.5 years. As price rose for over 6 years, it came on declining volume. That is not a normal profile for a bull market. For price to rise and be sustainable, it needs to be supported by volume. This bull market is not supported by volume. This is a more normal bull market. Here, as price rose, it was supported by volume. Up to the high here, we can see an increase in volume, overall volume increasing as price rises. This rise in price was sustainable, this one is not. I have an explanation for that in terms of Elliott wave. My bear Elliott wave count sees this upward movement as a B wave. There is something off or something wrong about B waves. There is something which doesn't technically make sense, or they're not supported by technicals or fundamentals. So if this is a B wave, it absolutely makes perfect sense that it has come on declining volume. And so that adds support to that bear market Elliott wave count. As price is falling, it's coming on rising volume. This fall in price at the monthly chart level is supported by volume, and that too supports the idea that this downward movement is not suspicious, it's supported by volume, it's a new trend. That supports the bearish Elliott wave count. As we came to the high up here before the dot-com crash, up to this all-time high, we had seen repeated negative divergence from RSI and price. As price came up to the final high, RSI failed to do so. We already had multiple negative divergence, and finally we saw a failure swing. RSI failed to reach into overbought as price made the all-time high back here. And that was a strong indication that something rather big was about to happen. We have seen it again here. We didn't see it here, but we did see strong negative divergence. Here, again, at the all-time high back up here, we saw a failure swing from RSI, which came after multiple negative divergence. On-balance volume is giving us a couple of very strong bearish signals. I find the on-balance volume tends to work quite reliably with long trend lines. Here's a trend line for on-balance volume for the entirety of this bull market. Tested 1, 2, 3 times, breached here, and we saw on-balance volume throw back to that line, further reinforcing the strength of that line and reinforcing the breach. When it breached this line, that was a fairly strong bearish signal. On-balance volume is moving down and away from that line. On-balance volume also showed double negative divergence to the all-time high. As price made new highs, on-balance volume failed to make corresponding highs. This shorter line, this is a monthly chart and it's squished up. So this is a reasonably long-held line on-balance volume. It's repeatedly tested. It's fairly shallow, and so it offers reasonable technical significance. On-balance volume has found resistance at that line and is moving strongly away from that pink line. Further bearish indication from on-balance volume. Let's have a look at the daily chart from this all-time high, which is back up at the left of the chart. Let's make that a little bit bigger again. So in the very short term, we had this little breakout coming on an increase in volume for Wednesday's session for this upward day. It's broken above this horizontal trend line and it's closed above the 200-day moving average. And it's come on an increase in volume. So that looks like we might be getting a small upward breakout underway. That doesn't support the main Elliott wave count, it supports the alternate. ADX is slightly turning up, still telling us that we've probably got a trend in place, and the trend is up because the positive DX line is above the negative. But, very importantly, ATR consistently disagrees. It's declining. That's more indicative of a consolidating or correcting market. Now that makes sense if this upward movement is a bear market rally, a counter-trend movement, and not a new trend. If this was a new bull market trend, then we really should expect ATR to be increasing as well. As price is rising, overall it's coming on still declining volume. Again, the rise in price is not supported by volume. The volume profile remains almost consistently bearish. It's not supporting the idea of a new bull market. RSI is not yet extreme overbought and neither is stochastics, and so we should be expecting further rises in price, at least until those two are more closer to an extreme. I'm going to have a look at some monthly charts for some Dow Theory now and look at the bigger picture, starting with the S&P. Here's the all-time high. We've had a series of lower highs and lower lows from that all-time high. The 200-day moving average has turned and now it's pointing lower. Prices closed today again above the 200-day moving average, but that does not mean that this upward trend is a new bull market. We do not have confirmation of that. That happened before up here, and this rise in price was more than fully retraced, and we saw new lows. Closing above the 200-day moving average on its own is not enough to tell us that this bear market trend is over. Here's our bear market trend line. I'm being very conservative in drawing this using the outline approached by McGee in that classic technical analysis of stock trends. For a bear market, we draw the trend line from the start of the bear market to the first major swing high within it and extend it out. We need to see that trend line breached by a close of 3% or more of market value on a daily basis before we can have confidence that the trend has changed from bear to bull. We used a conservative McGee trend line back in here, and that told us back down here, when that trend line was breached by a close of more than 3% of market value on this day here, that told us that the market had changed from bull to bear. Let's be conservative and use the same method from McGee again with this trend line here. Let's have a look at Dow Theory. The S&P has not managed to close below the prior October 2014 lows. This is the last major swing low in the prior bull market. When all of the indices that I'm watching close below this prior major swing low, then we will have Dow Theory, or my modified Dow Theory, finally confirming that we're in a new bear market, a new major downward trend. The S&P hasn't managed to do that. It's moved below that point, but it hasn't managed to close below that point. So for my modified Dow Theory, I'm going to follow the Dow Industrials and the Transportations as per the original theory, and I'm going to add the S&P, Nasdaq and Russell 2000. So here's Nasdaq. Nasdaq's corresponding major swing low in the last prior bull market is back in October 2014 at 4117.84. Nasdaq has not closed below that point yet. For Nasdaq, it remains below the 200-day moving average, and the 200-day moving average currently is still pointing down. It went from pointing up during a bull market, and now it's pointing down, telling us the probability is we're in a bear market. Here's the bear market trend line drawn using McGee's approach. Only when this trend line is properly breached to the upside will that trend line be telling us we've likely changed from bear to bull. The Dow Jones Industrials have closed below their major swing low of October 2014. Their 200-day moving average also is pointing lower, and the Dow Industrials remain below their new bear market trend line. So the industrials are currently looking like they're in a bear market, or at least those major technical indicators are telling us the trend for the industrials, the major trend, is down. The transportation index also appears to be leading the indices. It's had several closes some time ago, well below its October 2014 swing low. The 200-day moving average for the transportations is pointing down. We've got a series of lower highs and lower lows. Each of these rallies has been more than fully retraced, and so far we should assume the trend remains the same until proven otherwise. We should assume that this is a bear market rally until it's not. Here's its bear market trend line from the start of the bear market to the first major swing high within it. Also tested here first, extended out. We need to see that trend line breached by a close on a daily basis of 3% or more of market value before the industrials are telling us that the trend has changed from bear to bull. We do not have that yet. The Russell 2000 has also closed below its major swing low of October 2014. Its 200-day moving average is pointing down. It too remains below its bear market trend line. This one's quite steep. Let's see if it finds some resistance there. If the bear market remains intact, that trend line for Russell 2000 should provide very strong resistance from the start of the bear market to the first major swing high within it. Let's now start with some Elliott wave counts. This is my monthly bear market count for the S&P 500. Here's the first dot-com crash and the global financial crisis. So I'm seeing this as a 335 expanded flat correction, just an A wave of a big grand super cycle second wave correction, or wave W, the first flat in a double flat or double combination for a huge big grand super cycle second wave. There is no lower limit to this bear market. There is no lower invalidation point for this Elliott wave count. We will have full and final price confirmation when the alternate bull wave count, Elliott wave count, is invalidated with a new low below 1370.58. And for Elliott wave, the rules are black and white. A new low below this price point by any amount at any time frame will confirm this bear market wave count. And so I'm seeing this as a 335 expanded flat, and here we have a 535 zigzag. So we have A, B, C, or we have W, X, Y. Either way, we need substantial downward movement, and how the first piece of movement down unfolds, is it a 3 or a 5, is going to tell us whether we're looking at a Y wave or a C wave, and I'm not going to get into those complicated ideas today on the monthly chart level. For now, we are expecting from this wave count substantial downward movement. It's most likely a C wave, which should end substantially below the end of the A wave. This X or B wave is a 1.7 length of this A or W wave. Now that's a bit longer than the normal common maximum range of up to 1.38, but there's an Elliott wave convention which states that when your B or X wave gets twice the length of the A or W wave, then you should discard the idea because the probability is low. There is actually no clear rule, there is no rule stating a maximum limit for a B wave within a flat. And the B wave subdivides as a zigzag. Let's have a look at this wave count at the weekly chart level, where X or B up here, the all-time high, has ended here. It ended with a really nice ending contracting diagonal with a small overshoot of the 1-3 trend line. This structure has a pretty typical look. And here's that bull market trend line. I drew it in cycle wave C, the last part of the bull market, to be more conservative. It was breached by a close back in here, more than 3% of market value. So back in here we had an indication the market had changed from bull to bear, and that came in time to tell us of the strong downward movement which was expected. From this high to this low we have a fairly good 5-wave impulse. We have 1, 2 is a double flat, 3 is an impulse, 4, and a slightly truncated 5th wave. The truncation is less than 5 points. You will see a 5th wave truncation after a 3rd wave which moves too far too fast, and this 3rd wave absolutely fits that definition. Here we have a 3, 3, and I'm expecting a 5 up, a big expanded or running flat correction for a big primary degree second wave. The subdivisions all fit, particularly for the S&P. This downward movement, very importantly, this downward movement fits best as a zigzag 535. The B wave is well over 90% the length of the A wave. This B wave is 1.21 the length of the A wave. That's beautifully within the normal range of 1 to 1.38. And so this is either an expanded flat, or if the C wave is truncated, it could be a running flat. Here are 2 possible bear market trend lines. Now, whether you decide to draw the McGee bear market trend line on this first swing high or this more major swing high, it depends on where it sits about now. So I'm going to use both of those on my daily and weekly charts now. In the first instance, this perhaps less conservative but maybe more correct bear market trend line should find some pretty strong resistance if and when I expect price gets up there. Primary wave 2 may not move at all beyond the start of primary 1 above 2134.72. Any movement by any amount at any time frame fully and firmly invalidates the bear Elliott wave count. This wave count expects we're going to come to a nerve-wracking end to the second wave. For intermediate wave C to avoid a truncation, it has to move at least slightly above the end of intermediate wave A is at 2116, but it can't move above the start of primary 1 at 2134. The target sees it end within that very small zone, but once we get up here, I expect there will be most people calling for a new bull market, but that's not what this Elliott wave count expects it will be. It could fool a lot of Elliottians too, because a C wave of this expanded or running flat will subdivide as a 5, so we'd be looking at a 5 up almost to new highs before we turn around and have a huge primary degree third wave to crash to new lows. That's what this wave count expects. Let's have a look at it at the daily chart level, where intermediate wave A up here is this point here, and this is how the B wave subdivides so well. 5, 3 and an extended 5 for the C wave. Trying to see this as a 3-wave structure down, you would have to see the correction not over here but over here, and the only way to do that is to technically to see this as a double zigzag, and it just makes no sense, because this would be the second zigzag in a double. The purpose of the second zigzag in a double is to deepen a correction when the first zigzag doesn't move price deep enough. Not only would this not do it, it doesn't even move at all beyond the end of the first. It has completely the wrong look, and so I'm very uncomfortable with a wave count that sees the correction here, beginning here and ending here. And so what that means is from this high to this low, the downward movement subdivides best as a zigzag. It has a very good fit. So far within this upward movement, we may have 1, 2, we can see a completed impulse now for 3, meeting all Elliott wave rules, and I expect 4 is probably still continuing. It could be over here. I have an alternate hourly wave count looking at that possibility, but I expect it has a very low probability. And so I expect that minor 4 is going to continue maybe for another 3 days to total a Fibonacci 5. Minor 2 was a 0.389, I think, so relatively shallow expanded flat correction. Let's expect some alternation for minor 4 that would meet the guideline, and it can't move into minor 1 price territory below 1930.68. Draw a channel around this bear market rally using Elliott's technique from 1 to 3 with a copy on 2. If it takes that long and gets that low, look for minor 4 to find support at the lower edge of that channel. If minor 4 ends about this level, and I'm taking the target from here, so it will change as minor 4 moves further sideways, and if it ends about this level, and that's where minor 5 begins, then at 2126, minor 5 will reach equality in length with minor 1, and that target will see intermediate C move at least a little beyond the end of intermediate wave A, which had its end at 2116, and it would see primary 2 not invalidated. It would end below the invalidation point. It would probably find resistance at this lilac trend line. Let's have a look at the hourly chart, and I have 2. The first one, minor 3, ends up here, this point up here. We have a 335 expanded flat here, and this is too brief, I expect, to be minor wave 4 in its entirety, and so I'm going to label this now as minute wave W, the first flat in a double, or the first flat in a double flat, or the first flat in a double combination. We could also be looking at a sideways triangle for minor wave 4. I expect minor 4 might end at the 0.146 Fibonacci ratio. That's not an option in Motive Wave's Fibonacci retracement tool, but it is mathematically correctly a Fibonacci ratio. It's perfectly at 2000 exactly. That would see minute wave Y of this double flat or combination end about the same level as the first structure in the double, labelled minute wave W, so that the whole thing would have a sideways look to it. And that's what combinations or double flats should look like. They should have a sideways move to it. If we see a new low tomorrow below 2019.06, I will have confidence in this hourly wave count at the hourly chart level. I will have confidence that the consolidation that I am labelling minor wave 4 is not over and should continue sideways for another 2 or 3 days. The invalidation point at the hourly chart level is the same as at the daily chart level. This upward movement to the end of minor wave 3 does look like the end of a third wave, and it exhibited some divergence with MACD. This upward movement was weak. It did not have stronger momentum than the middle of the third wave back here, and also if we go back and look at further movement off to the left of the chart, you'll also notice that this third wave, the whole of it, was weaker in terms of momentum than the first wave, and so I'm expecting the upcoming fifth wave for minor wave 5 to be even weaker still. Lots of slow, small range days, probably continuing upward and very weak upward movement. This is the alternate idea at the hourly chart. It's identical to this point here, and I've just moved this little piece of movement up 1 degree. What if this is an expanded flat correction, and what if minor wave 4 is over here? It would have lasted only 1 day, and there would be no alternation, well, only slight alternation with minor wave 2. They would both be expanded flat corrections, so there's no alternation in structure. Minor wave 4 would have a little alternation. It's a lot more shallow than minor wave 2, but that's all. With an adequate alternation, I expect this is not the right wave count. It is presented as a what if. What if I'm wrong? I'm providing a price target in my text article. If price moves above that target or that confirmation point, then I expect that we're in minor wave 5 up. So far within minor 5, whatever degree we choose to label it, we would have 1 and 2. It could be minute, but we could move the degree down 1. We'd be expecting 3, 4, and then we need 5. 4 can't move into 1, so here's the invalidation point for this idea. If we see a new low below 2019.06 tomorrow, then that tells us that from this low to this high, the upward movement fits as a 3, and it's complete. And so that tells us that that first hourly wave count has a much better fit, is much more likely to be correct. This is at the monthly chart level, my bull wave count. The subdivisions are all almost exactly the same. 335, an expanded flat, 535, 1, 2, 3, because 1, 2, 3 and ABC of a zigzag have exactly the same subdivisions. This is a best fit channel drawn from the extreme of cycle 1 along to these highs in cycle 3 with a copy on cycle 2. Quite closely shows us where recent downward movement found some support. If the bull market has resumed down here, and if we are not about to see a huge bear market crash and the bull market is about to resume, then this is the best wave count I can see. It has the best fit. At 2500, cycle 5 would reach equality in length with cycle 1. Cycle wave 4, if it continues further, can't move into wave 1 price territory, which has its extreme at 1370.58. Let's look at this at the weekly chart level where cycle 3 ends up here. And so we have to see this cycle wave 4 as a flat correction, 335, and that allows it to have alternation with the zigzag of cycle wave 2. Here's the problem. We have to see 1, 2, 3, 4, 5. This second wave correction has to end here. Let's have a look at why this is a problem at the daily chart level, where primary wave B up here within the flat is this point up here. And now you see we have to see intermediate wave 2 over here. From here to here, we have to see this downward movement. If this bear market movement is over at the low here, from an Elliott wave perspective, this wave down has to be seen as a 5. And here's the problem as I outlined before. Intermediate wave 2 has to begin here. I don't want to see intermediate wave 1 over here. That just doesn't fit. Here it's a 5 wave impulse, but now intermediate wave 2 is a double zigzag. This structure is a zigzag. It does not meet the rules for any other corrective structure. This structure also does not meet the rules for any other corrective structure than a zigzag. We cannot see this as a flat because B is less than 90% the length of A. And so if the correction was over here, it's a double zigzag. But not only has the second zigzag in the double not deepened the correction, it's failed to move price even at all beyond the end of the first. It failed to get there. This does not look at all right. It looks completely wrong. For that reason, I have very little confidence in this wave count, apart from all the other technical indicators. From an Elliott wave perspective, trying to see this rally as a new bull market is highly problematic. If this is a new bull market, then this is the absolute best wave count that I have been able to see to date, which sees the big downward movement over at the last low down here. So far to the upside, the subdivisions are seen in exactly the same way because 1, 2, 3, 4, 5, we're still seeing a 5 wave impulse up for both wave counts. So the target is the same, the hourly chart is exactly the same, including the degree of labelling, and the invalidation point is exactly the same. If we see a new all-time high, then this wave count would be confirmed by price. It would be very obvious that the bull market has resumed. We are not there yet. So this upward movement we've been seeing for the last few weeks is a bear market rally, until proven otherwise. That's all for me today with your S&P analysis, and I hope that all of our members are having a fantastic day.